Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
The standard VAT rate in the UK is 20%. If an overseas company wants to do business in the UK, a key decision is whether to operate through a UK branch or a UK subsidiary. At first glance, they can look similar, but the structure affects when the UK taxes profits, which profits the UK taxes, how losses can be used, what has to be filed publicly, and how easy it is to shut down or sell later. An overseas company can begin UK-related activity without creating a taxable presence immediately. But if the UK activity becomes more than paritory or auxiliary and turns into a real operating footprint, the company may create a UK taxable presence. That's where the branch versus subsidiary question becomes real. A UK branch is not a separate legal entity. It is simply the overseas company operating in the UK. For UK tax, the relevant concept is often a UK permanent establishment. A permanent establishment can arise where there is a fixed place of business in the UK through which the business is carried on, or where a person in the UK habitually acts on behalf of the overseas company and habitually exercises authority to do business for that company. An overseas company can create a UK permanent establishment without intending to if UK activity expands over time. If there is a UK permanent establishment, the UK can charge corporation tax on the profits and gains attributable to that UK permanent establishment. A UK subsidiary is a separate UK incorporated company. Because it is a separate legal entity, it is taxed in its own right and is generally within UK corporation tax on its worldwide profits and gains. The overseas parent is separate and is taxed under its own local tax rules. Both routes involve registrations and filings, but the public transparency differs. If an overseas company opens an establishment in the UK, it must register that UK establishment with Companies House, and a UK branch may have to file the overseas company's financial statements in the UK. A UK subsidiary files its own financial statements and maintains and files people with significant control information. Some parents prefer subsidiaries because the UK filings do not automatically expose the parent's accounts. If the UK venture fails, a branch is typically easier to wind up because it is not a separate company. A subsidiary, as a separate legal entity, may require formal steps such as striking off, winding up, or appointing a liquidator. The tax scope differs. A branch is taxed in the UK on profits and gains attributable to the UK permanent establishment. A subsidiary is generally taxed in the UK on its worldwide profits and gains because it is a UK company in its own right. Losses are often a deciding factor. Branch startup losses may be usable in the parent's jurisdiction, depending on local rules. Subsidiary losses generally sit in the UK company and are carried forward against future UK profits, unless group relief is available. Funding can also differ. If a parent funds a subsidiary by debt, the subsidiary will generally have a UK tax deduction for arm's-length interest, subject to UK restrictions. With a branch, internal head office charges are not the same as third-party expenses structurally. The overseas parent's tax position also matters. With a branch, the parent may be taxed on UK profits as they arise, with relief for UK tax paid depending on local rules. With a subsidiary, the parent is generally taxed when dividends are paid, again depending on local rules. A branch can be incorporated later once the UK venture is established. Reliefs can sometimes make that transfer tax efficient in the UK, but overseas tax consequences still need to be considered. And this brings us back to the fact we opened with. Some rules are fixed numbers that apply across the board, like the UK's standard VAT rate being 20%. But in corporate tax, structure often decides outcomes just as strongly as the numbers do. That's why branch or subsidiary is not just paperwork. It can change what gets taxed, when it gets taxed, and what gets filed publicly. I told my account a joke about depreciation. It lost value over time. This content is for educational purposes only. It is not tax advice. Tax rules can change and outcomes depend on individual circumstances.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.